Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 17th of September. My name is Zhong, and I'm standing in for Daniel Lam, who is still competing in the Chess Olympiad in Hungary. China markets are taking a break today as the country celebrates the Mid-Autumn Festival, also known as the Lantern Festival and Mooncake Festival. However, the celebratory mood is probably dampened by the weak macro data that were released over the past few days. Firstly, August activity data were largely disappointing. Factory output slowed from 5.1% year-on-year to 4.5% year-on-year, against consensus of a 4.7% year-on-year increase. Retail sales also slowed more than expected to 2.1% year-on-year from 2.7% year-on-year in July. While both fixed assets and property investment came in line with expectations, they were still weaker on a month-on-month basis. Secondly, August credit data continued to point to subdued credit appetite. Total social financing growth decelerated from 8.2% year-on-year to 8.1% year-on-year, which marks a new record low. If you strip out the local government bond issuance, the measure was lower on a year-on-year basis, suggesting that bulk of the credit demand weakness could be attributed to private sector business and households. In addition, M1 money supply contraction deepened from 6.6% year-on-year to 7.3% year-on-year. The weak credit demand amplifies the concern of further deterioration in growth momentum and the risk of a liquidity trap. The silver lining among all these weak macro data is that the authorities are planning to take actions to rejuvenate the economies. In a rare statement accompanying the credit data release, the PBOC said that it will make maintaining price stability and pushing for mild rebound in prices an important consideration for monetary policy. It also added that it's prepared to launch more additional measures, further lower the financing costs for business and households, and keep liquidity reasonably ample. Assessing all this in the context of markets, the balance case argues for core holding to China equities. For China dollar bonds, the technical factors, including contained primary supply and strong regional demands, support a tactical buy on China dollar bonds. Lastly, the prospect of further PBOC easing weighs on dollar CNH, though that is mitigated by the likely deeper easing cycle in the US. With that, I'll close off today's podcast. If you enjoy this podcast, please help us to like, rate, and share it. Thanks for tuning in, and speak to you again tomorrow.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.